All right, let's get right into it. We all get into investing because, well, it feels like the road to financial freedom. But here's the thing about that road. It's not always a smooth, easy climb. Sometimes it takes a really sharp, stomach-dropping dive. We're talking about those moments the market just tanks, and you're left staring at a screen that's bleeding red.
Man, it's a gut-wrenching feeling, isn't it? To watch those numbers that stand for your savings, your future, your hard work, just shrink. It feels like a punch to the gut, and it's almost impossible not to take it personally.
But what if I told you that these exact moments of pure panic are where the game is actually won or lost? Seriously, it's not about picking the one magical stock. It's about how you handle yourself when everyone else is losing their minds. And that's exactly what we're going to break down right now.
And just real quick, if you like this and our other explainers and finally give you some value, do me a favor and hit that subscribe and like button. It helps me out a ton in the fight against the algorithm, and it lets other investors find this information too. Okay, now let's get to it.
So why? Why do market crashes feel so incredibly terrifying? The short answer is pretty simple. Our brains were built for survival in the wild, not for navigating the ups and downs of the stock market.
You see, this is the real heart of the problem. Think about it. When our ancestors spotted a lion in the grass, their brain didn't pause to analyze the situation. It just screamed, "Run!" That's fight or flight. Well, when your modern brain sees a 20% drop in the market, it does pretty much the same thing. It sees a predator, it floods your system with fear, and it tells you to do one thing: get out, sell, save whatever you can before it's all gone.
And that primal panic pushes us right into some classic psychological traps. We're going to focus on the big three that trip up almost every investor. That intense sting you feel from a loss, the primal urge to follow the herd, and that sinking feeling that the pain is just never, ever going to end. First up, loss aversion. What researchers have found is pretty wild. The emotional pain you feel from losing $100 is about twice as strong as the joy you get from gaining that same $100. It's a total mismatch. And it means that market downturns feel way, way worse than they should, which makes us desperate to just stop the bleeding, usually by selling at the absolute worst time. Then there's herding. Look, we're social animals. We're wired to feel safer in a group. If you see everybody running for the exit, your instinct is to run right along with them, no questions asked. In investing, though, that leads to a full-blown panic. The crowd is always the most terrified at the very bottom of the market and the most giddy at the very top, which is the exact opposite of a smart strategy. And all of that leads us right into our final trap, this illusion of permanence. When you are in the middle of a storm, it is almost impossible to imagine the sun shining again. During a crash, our brain takes what's happening right now and just assumes it's going to happen forever. We completely forget a simple, crucial fact. Every single market storm in history has eventually passed.
And believe me, these traps are nothing new. Just look at history. In 1987, fear went viral, like a contagion. In 2008, investors just gave up. They capitulated right at the market bottom, literally moments before one of the biggest bull markets in history kicked off. And in 2020, the whole cycle happened so fast that anyone who reacted on emotion got left in the dust. The names and dates change, but the human reaction, it stays exactly the same.
Okay, so we get the psychology now, but what's the actual real-world cost of giving in to this fear? Let's put some numbers to it because honestly, they're staggering. Okay, so imagine you invested $10,000 in the S&P 500 at the start of 2003. Now, what if you just did nothing? You just held on through all the chaos, all the ups and downs for the next 20 years. Your investment would have grown to this, almost $65,000. But now, look what happens if you panicked, if you got scared and tried to jump in and out of the market. If you miss just the 10 best days over those 2 decades, your return gets cut by more than half. Miss the 20 best days and you're down to just over 17 grand. Miss 30, you've barely made any money at all. The key takeaway here is brutal. Trying to dodge the worst days almost guarantees you'll miss the best ones. And here's the kicker. Here's why. The market's biggest comeback days almost always happen right on the heels of its biggest drops. They are violent, they are sudden, and they are completely unpredictable. By the time the news starts to sound safe again and you feel okay getting back in, guess what? The biggest gains are already long gone. All right, so we know the psychological traps, and we've seen the devastating financial damage they can cause. The big question is, how do we fight back against our own worst instincts? Let's open up the playbook for not just surviving these crashes, but actually coming out stronger on the other side.
It really starts with 3 golden rules. First, for the love of all that is holy, stop refreshing your brokerage app a dozen times a day. It just feeds the anxiety. Second, you have to reframe how you think about volatility. Those scary drops aren't a fine you pay for being wrong, they're the price of admission you pay to get the market's long-term returns. And third, just accept it. You cannot time the market perfectly. Nobody can.
So here are a few practical habits that can really help you build that discipline. Invest a set amount regularly, like clockwork. It's called dollar cost averaging, and it forces you to buy more shares when prices are low. Keep a cash reserve on the side so you never have to sell your investments in an emergency. And my personal favorite, write down why you invested in the first place. When the panic starts to creep in, pull it out and read it. That's your anchor in the storm.
And this all leads us to the wisdom of the great Benjamin Graham, who was basically the godfather of value investing. He said that your success has way less to do with your IQ or your financial models and everything to do with your temperament. It's about having the right mindset, the right character.
And of course, his most famous student, Warren Buffett, boiled that whole idea down into maybe the most famous line in all of finance. And you have to understand, this isn't just a clever line. It's a command to do a complete 180 on your natural human instincts. It's about seeing a crisis not as a threat, but as a once-in-a-decade opportunity.
So that leaves us with one final thought to chew on. In this crazy world of investing, with numbers flying everywhere and emotions running high, maybe the most valuable thing you have isn't your stock picking skill or how well you can read a chart. Maybe, just maybe, your greatest asset is your character.